Hi, everybody. I am going to go through these last journal entries with you. So by now you will have done your reading quiz, and I will have taken a peek at those scores. So what I'd like to do is just go ahead and read them and prompt you. You're going to just start and stop the tape just like we were in class. So I'll read it, and then I'll just launch into how to solve it. But you're obviously going to turn it off and work the problems yourself. So get your journal set up, get your calculator, get your pencil, et cetera, et cetera. Okay, on September 30th, Sarah receives 2 invoices in her business mailbox. One is from an advertising agency for $600 and the other's from the corporate attorney for $186. So she's gotten these in the month of September. So we need to make a month-end AJE, and then she pays the ad agency, she pays the attorney, and she pays them amounts. So here she pays them $1,100, and that includes the $600 that she had accrued in September. So this is very similar to the wage entry that we made. So I'm going to have you turn off the tape, make the AJE, and then I'll walk you through booking the payment to the ad agency and booking the payment to the attorney. Okay, so now when you're coming back, you will have already made these entries. So on the 30th, this is called, which of the 4 types is this? This is an accrued expense, right? Because the action happened first and the money's going to happen later. So it looks like she's got advertising expense that we need to get into the month of September for $600. And then she's got legal expense that we need to get into the month of September for $186. And so then I look at it and I say, yep, I've hit a P&L account. Now I have to hit a balance sheet account, and I never use cash. And then this is just good old fashioned accounts payable. So now my books at the end of September have appropriately booked a an accrued expense. And now I'm in the next month and the actual transactions are happening. I'm cutting checks. So the first thing that happens is on 10/17. And again, I'm going to go down a couple lines and do the cash piece first because that's easier for me. So I know that I wrote a check to my advertising agency for $1,100. How do we make cash go down? We credit it. Okay. And then I said that in that, of that $1,100, $600 of it was from that September expenditure. Well, much like when we did the accrued wages, that $600 is part of AP. So that's a liability. I'm decreasing it because I'm now paying it, right? So I want to get rid of that $600 of accounts payable that I have accrued in the prior month. Therefore, what's the other $500? That is the expense that belongs to October. And so my P&L for September, yep, $600. P&L for October, yep, $500. Doesn't matter when I pay it. Accrual accounting tells me that. Exact same situation here. I'm gonna get rid of my accounts payable of $186. I've got some legal expense. I haven't figured out that number yet. I wrote out a check for what, $540. So the difference between 540 and 186, it looks like I had $354 of legal expense from that month. So that was number 8. That was an accrued expense. All right, let's pop over here. So on January 1st, Liam purchased a building. for 85 grand. He paid 25,000 in cash and issued a note for the balance. It is a 2-year, 7.5% note. And the building has a 20-year life. So there's a lot of things going on here. He's bought the building. That's just a regular old transaction. Then it looks like on January 31st, we have to do an AJE for depreciation. Okay, so again, you're going to do that calculation, cost minus salvage value, which is 0 because I haven't told you otherwise, divided by the number of years in the life, and that gives you the annual depreciation. And you're doing that for 1 month. And then lastly, you're going to book an AJE for interest. He is going to accrue interest every month. And this looks exactly like wage expense, wage payable. Like the last one we just did, it is an accrued expense. So shut the tape off, make these 3 journal entries, and I'll meet you back here. Okay. So on 1-1, pretty straightforward. We have an asset of a building, right, for 85 grand. I wrote a check for cash for 25 grand, so my cash went down. And then I signed a note for the other 60,000. And the note is the one that carries the interest. So we're gonna, every month, we're gonna need to acknowledge that we're accruing expense, interest expense. And then at the end of the life of the note, which is I think 2 years, then we'll pay the 60 grand plus all the interest we've accrued. So we've got 2 entries to make on the 31st. The first one is for depreciation expense. So let's just go do that number together so we know what we're planting in here. So my depreciation expense equals cost minus salvage divided by years. So the cost was 85,000. The salvage is 0, and I'm dividing that by 20 years. So annually, it looks like my depreciation would be 4,250. But we're not doing that because that's an annual number. We're just doing it for 1 month. So I divide by 12 months, and it looks like $354.17. So 354.717, 354.17. And again, depreciation is a special category of adjusting journal entries. It is a type of really long-term prepaid or deferred expense. So we have to get 1 balance sheet account and 1 P&L account. And if you recall, our depreciation expense account is always just slash whatever it is you're depreciating, the category of asset. So in this case, it's a building. So now I've used my P&L account. What am I going to use for my balance sheet account? And we're going to use our newly learned about contra asset called accumulated depreciation building. Credit balance goes against the building. Then I've got to make an accrued expense entry. Every month I'm going to owe the gal that I bought the building from some interest. Well, let's go calculate the interest. So we know it's 7.5% APR, and the principal is 60,000. Okay. And the time is 1/12 because we're accruing it for 1 month. So interest equals principal times rate times time. I'm going to go fill in that calculation now with a formula. So equals principal times rate, 7.5%, times, and our time is always something divided by 12 if it's for a shorter time period than a year. And that's because the interest rate is quoted as an annual rate. So my time is 1/12 And it looks like my interest is a nice, is there any pennies to that? Nice, neat, even $375. So I'm accruing an expense. So action first, money later. One P&L, one balance sheet. And all these accrued expense, what was my number, 325? All of these accrued expense journal entries look exactly the same, 375. Debit and expense, and now I need to, of course, hit a balance sheet account. I owe it, along with the 60,000, I'm gonna have 2 years of accrued interest. I'm gonna do this every month. That seems high. 60,000 times 0.075 divided by 12. Oh, no, that's right. $375. Okay. And let's take a look at the next one. So on 8/1, Lofton received $10,000 as a retainer for a big client. He's an attorney. I don't know what this means. So I've just said to him, hey, I want you to work for me. And he's like, you've got to give me $10,000 down. Okay, has he earned anything at this point? So on 8/30 by August, Lofton has billed the client $20 20 hours at $100 an hour. So I want you to make the journal entry where Lofton receives the 10 grand. And then I want you to make an adjustment at the end of the month to identify his accrued, or no, sorry, this is a deferred revenue, right? Because they've given him something he hasn't earned. And now at this point, you've got to say, hey, he's actually earned part of this retainer. So turn off the tape, make the journal entry. We've done these before. Okay, so hopefully you correctly identified this as a deferred revenue. He got cash, but he hasn't performed the action yet. So that is a deferral. So just the actual transaction, this isn't an AJE, of course, because it took cash. He takes $10,000 to the bank from the client, but he hasn't done anything to earn it yet. That's what a retainer is. So what does Lofton need to set up on his books? A liability. And again, just call it what it is. The key word here obviously being unearned, which indicates it's a liability. So he's got 10 grand in the bank, but he hasn't done anything to earn it. At the end of the month, we have to make an AJE to acknowledge that part of that is now earned. He worked 20 hours. He bills $100 an hour. So he's earned $2,000. If you correctly debited this account, good, because that's what you do. His liability just went down by 2 grand. And so now we've used a balance sheet account, right? The liability, the legal revenue, actually has to go to his P&L for $2,000. Great. And lastly, we're going to do one more. So this one is, here I am at the end of October, and Tam loans a business associate 10 grand. So it's somebody say that she wants to help them develop their business because she thinks there's going to be potential collaboration in the future. So she says to her business associate, okay, here, I'm going to write you a check for 10 grand. I'm going to charge you a nice, healthy, oops, I misspelled principal. I'm going to charge you a nice, healthy interest rate, 8% APR. And I'm going to give you 1 year to pay me back the 10 grand plus all the interest. So the first thing, you're going to make the journal entry on the date that she actually lends Tam the money, which just happens to be the end of the month. I guess that's kind of confusing because that looks like an AJE, but it's not. It's just she gets out her checkbook and writes her a check on the 31st. So that's a regular old transaction. And then oh gosh, I've got typos all over the place here too. You must be wondering who Sam is. So then at the end of the year, Tam closes her books every year. So she closes the books on 12/31. She needs to accrue 2 months of interest. And then I want you to really think about what it is. Is this a receivable or a payable for Tam? She lent the money and now she's accruing interest. So go ahead, make the 1031 journal entry where she actually just cuts the check to her friend. And then 2 months later, she closes her books. So I'm going to start with the cash because I know that's easy. I know I wrote a check to my business associate for 10 grand. What does she have on her books now? It's not an accounts receivable. They've signed a note. This is an asset just like AR. It's just a formal notice signed. Now she goes 2 months down the road. And again, this is not an HAE. And in this journal entry, she needs to accrue revenue. She's earned revenue, but she hasn't got the cash yet. What's the math on this? The math on this is interest equals, I always write this out so I don't forget it, times rate times time, where your T is something divided by 12. Let me just make this a little bigger so I can see it. So my principal was 10,000. My rate is 8%. My time is what? 2 divided by 12. 2/12 of the year. All of November and all of December. $133.33. So accruing revenue, I know I need one balance sheet account, one P&L account. I'm going to do the revenue. I know it's interest revenue. That's what I'm earning. That's why I lent her the money, so that I could earn some interest and hopefully help her get her show on the road that's somehow going to help me. And this is a receivable on my books. So I've used my P&L account here. My debit is to interest receivable. It's an asset on my books, just like accounts receivable, notes receivable, anything else. It's something that I own. She's going to give it to me at the end of the year. So now we finish this up. So the type of entry is accrued revenue. And now here we are a year later, 10/31 of the next year. And she's going to pay me a chunk of cash. Think it carefully what she's going to all give me. She's got to pay me back the note. And she's got to pay me back all the interest. Interest for 1 year. But be mindful that I have already accrued 2 months of revenue in the prior year. So this year, I'm only recording revenue for 10 months. So this is a challenging journal entry. Give it a shot. I'll tell you there's 4 accounts. You're going to use 4 accounts. Credit your cash first. No, don't do that. Pull your note off first. Then think about the interest and then credit your cash. Okay, so here I am a year later. Tam's going to write me a check for everything that I lent her, plus a year's worth of interest. Well, one thing I know right off the get-go is I no longer have this asset. I think maybe in the instructions, I said something about crediting cash. You're not crediting cash, you're getting cash from her. Sorry. So I need to pull the receivable off my books. I no longer have that asset. She's paying me. What she's paying me, I don't know yet. I'm just gonna leave that debit there. Well, I've got another receivable on my books that's part of the whole chunk of cash she's giving me today. And that's this amount that I accrued last year. So I no longer, after today, after she pays me, I don't have a right to that. And then I also have 10 months of revenue in the current year because I only close my books once a year. I haven't accrued any interest for the next year. How many months worth? 10 months worth. Interest equals principal, 10 grand, times rate, 8%, times time. Well, what's my time here? It's 10 months. So I have at $666.67 of revenue in the current year. So what's Tam paying me? 10 grand, 2 months from last year, 10 months from this year, which is the 1 year of the note. She's writing me a check for $10,800. So I hope these were helpful. I think these are more complicated than the ones you're going to be doing in the book for sure. So go work the homework I asked you to. If by some stretch of the imagination I'm not there on Thursday, I will obviously be emailing you and letting you guys know. Otherwise, I hope you're well, and I will see you soon. Okay, bye.